All right, well, between market sell-offs, tariff fears, and some big earnings disappointments, it's been quite a busy week for investors. But this week also served as a turning point in a markets discussion happening in the background of all this daily news flow. And that is whether negative interest rates actually make sense, intuitive, logical sense, or not. Now, Bloomberg editor Joe Weisenthal has been leading the charge on Twitter, arguing that positive interest rates might be just as weird as negative interest rates, terming some folks yield bugs if they believe that rates should be positive. But then PIMCO global advisor Joachim Fels really kicked the conversation into another gear this week. He wrote on Wednesday in a blog post on PIMCO's site that negative treasury yields here in the U.S. cannot be ruled out during the next recession. Now, the record low, Brian Cheung on the 10-year, 138. So quite a bit of work for the 10-year to go negative. We have never seen negatives even further up on the shorter end of the curve. I am old enough, as you are, to remember that in 2016, Janet Yellen actually told Congress that we can't rule out the possibility of negative rates here in the U.S. So I think there's kind of two discussions. Let's start with the idea of negative yields. So we've seen negative yielding debt in Europe because we have negative rates from the ECB. Basically, investors are paying up to borrow money, and they're having to effectively compensate the German government, for instance. Do you think that's a realistic outcome here in the U.S. in another recession?
I think yes, and you're seeing that across the board, central banks are lowering their interest rates, which is really backing up some of these yields towards the zero bound and then into the negative if it tips bad enough. I mean, you saw just this week, actually, in the past few days, India dropped by 35 basis points. Thailand dropped by 25. They're now at 150 basis points of interest rates. New Zealand backed out by 50 basis points. They're now at 1%. I mean, all these central banks around the world are coming down. And there's been research showing that even though each central bank claims that they operate their monetary policy in a bubble, they all tend to react to the Fed and to each other, right? So I don't really see a case where we don't end up actually getting into negative yields. I think there's an important distinction here, right? There is a difference between negative yielding instruments on a treasury and then also negative interest rates from the central bank. So the Fed doesn't need to go negative on interest rates. They can go to zero and then end up using quantitative easing in the next recession, but that could still send the 10-year negative because we've already seen the trending inversion in the yield curve.
So, we of course are not saying that the Treasury Department would issue a Treasury note or a bond that would have a negative yield. The government would not literally be receiving coupon payments from its borrowers, but on the secondary market, the amount above par that investors would pay for that instrument would make it a negative yielding instrument. Now, that gets to the conversation that I think is really happening on Twitter, the yield bug conversation, which is, does it make sense for some investors to actually be paying more than the lifetime value of a fixed income instrument just because that means they're guaranteed? If I put $10,000 into a government bond that has a 0.5% coupon, I know exactly how much I get back in 10 years. Does it make sense for me to do that? Because I think a lot of people, and the investing textbook, the CFA textbook says you would never do that, right? You would never.
The rate is always going to be positive.
You would never give away your money, but it does feel like that is now becoming arbitrary, right? It's in so many markets around the world. I don't see why you should be entitled to a positive return, especially if you are basically rent-seeking by parking your money in a government bond.
And I agree with you. I am not a yield bug, nor am I a Knicks fan, as you have claimed falsely on this show before in the past. But I mean, it raises a good question. I mean, Joe, I think, put it in a really concise kind of Mainstreet way, which is that if you take your laptop or your valued watch and you put it in a deposit box, you have to pay for that. You have to pay for a security guard.
Negative yield.
Right, that has a negative yield. You do not earn money to protect your own assets. So 10-year treasuries or treasuries for that matter, government issued bonds that will pay out that coupon at some point in time. If you want to run to those assets to hide, why should you
get paid?
Why should you be compensated for that? And there are structural changes in the way that the globalized world operates this day, where people are living longer, people are hoarding money, people are putting money. This is what Fels was talking about, is that savings has been a huge glut over time. And at a micro level, you could make arguments against this. But at the macro level, it is true that people are saving a lot because people are worried that they're living 20, 25 years longer than 2 generations ago was. So you need to save up to hold on to that money. But the problem is that when you're hoarding that money, the time value is being held to a point where you're actually not allowing enough consumption to spur any sort of economic engine for the time being.
Well, and so the reason that and I'm not really disagreeing with you here, but just in thinking about why people would have basically what Joachim Fels is talking about is a negative time preference for money. They want their money in the future. They don't want their money now. I think that means that people have too much money, right? Because I personally am not putting my money in negative yielding assets because I need the money that I am making now. Most people need the money that they're making now. But if I were a billionaire who had more money than I could spend, I actually wouldn't want it now. I'd want it in the future, and I should not be rewarded for that. I should have to pay for the privilege of getting all my money back in 20 years if I can't find a productive use for that money right now.
And here's the key word that you just said, productive, right? Everyone says that in the US and Japan, the biggest issues that are facing our economy in terms of getting GDP growth even higher than it could be right now is the lack of productivity. And you could make the argument that the reason why we don't have more productivity is because the previous generations, and not to be the millennial that's blaming the baby boomer, but it's
blame the boomers.
It's because they've been putting all that money in savings and haven't been investing it into maybe speeding up the technology that we could have had 20 years ago or whatnot. But I mean, it does raise, negative interest yields it has other issues too, right? One issue being cash hoarding, right? So if there's negative yields on bonds and people don't want to go run there for risk-free assets, then they'll just hold on to what is zero nominal interest on cash. So
there's concerns about the deflation spiral are real, but the reality is that you and I and most people, like